financial year 2025 to 2026 just closed. And whether you realize it or not, four major things happened this year that directly impacted your money. Your EMIs, your savings, your investments, your tax outgo. All of it was touched by these four events. Most people either ignored them or didn't even know that happened. And because of that, they entered the new financial year with the same gaps, the same mistakes, and the same missed opportunities. Today, we are going to change that and break down exactly what happened, how it affected your money, and most importantly, what you should do differently starting financial year 2026 to 2027. Let's get into it. Event 1. RBI cut the repo rate by 100 basis points. Between April and December 2025, the Reserve Bank of India cuts its repo rate by a cumulative 100 basis points, bringing it down to 5.25%. Now, if it sounds exactly just a number, let me tell you what it exactly means for you. The repo rate is essentially the rate at which the RBI lends money to banks. When it goes down, borrowing becomes cheaper across the board. Let's find out their pros and cons. The pros: if you have a home loan, your EMI either came down or your tenure was shortened and the credit becomes more accessible. If you were planning to take a loan, this was the best time to do it. The cons. But here's the other side. If you had money sitting in a fixed deposit, your returns quietly dropped. Banks lowered their FD rate in response to the repo cut. Debt mutual funds also saw their returns soft. A quick tip. A smart move was to lock in higher FD rates before the cut came and to review your debt portfolio, shifting towards instruments that benefit from falling rates like long duration bond or debt funds. Event 2. Union budget gave the middle class a tax break. The Union Budget 2025 to 26 raised the personal income tax threshold significantly, putting out money directly in the hands of middle-class Indians. For many salaried individuals, this meant thousands of extra rupees every month that they weren't paying in the tax anymore. The pros? There was more disposable income, more room to save and invest, and a genuine opportunity to accelerate wealth building. The cons. For most people, that extra money didn't go into investments. It got aborted into lifestyle. A better phone, a more dining out, a slightly bigger EMI they could now afford. The government gave you financial opportunity, the most people spend it instead of investing it. A quick tip. The moment that tax relief came in, that exact amount should go into an SIP or an investment account, not the lifestyle budget. Because that one decision, made consistently over 10 years, is the difference between building real wealth and just earning more. Event 3. India's historic low inflation 1.7%. According to the Economic Survey of India 2025 to 26 presented in Parliament, India recorded a historic low inflation of just 1.7% between April and December 2025. Vegetables were cheaper, fuel was stable. The cost of living genuinely eased for millions of Indians. The pros? Your purchasing power improved. Your real income, what your money actually buys, went up without you doing anything. The cons. Low inflation is great for your grocery bills, but it quietly hurts conservative investors. If your money was sitting in a saving account earning 3% and inflation was 1.7%, you would be barely growing in real terms. And for those invested in inflation-linked instruments or very conservative debt funds, returns were significantly compressed. A quick tip. Low inflation environments are actually the right time to shift towards growth assets, equity mutual funds, SIPs, and diversified portfolios. Because when inflation is low and rates are falling, growth assets tend to perform better. Event 4. The Iran-US-Israel War. In June 2025, Israel launched a major military operation against Iran's nuclear facilities, drawing in the United States and triggering a 12-day war that ended with a ceasefire. 8 months later, in February 2026, the conflict reignited. This time more intense, with the US and Israel striking. Iran again. Iran closing the Strait of Hormuz and the entire Middle East being pulled into an open-ended conflict. Now you might be thinking, this is a war in the Middle East? What does it have to do with my money in India? The pros. Honestly, there are no big positives for India with oil prices spike. But history does give us one consistent pattern worth knowing. Every time India faces a Middle East oil crisis in 1973, 1990 and 2003, the initial pain was real, but the recovery always came. In fact, in 1990, Gulf War crisis, as devastating as it was, ultimately pushed India to launch its landmark 1991 economic reforms that transforms the country's economy for decades. Crises are painful, but they are also forced changes. And changes over time build resilience. For investors, especially IT and pharma companies, actually tend to do better during these periods because they earn in dollars. When the rupee weakens, their earning in rupee terms go up. So while most sectors struggle, these tend to hold or even gain grounds. The cons. India imports over 85% of its oil. This meant direct pressure on fuel prices, transportation costs and inflation. The rupee also came under pressure as global uncertainty triggered foreign portfolio investors outflows from emerging markets including India. Supply chain were disrupted and the general uncertainty made markets volatile, which hurts investors who panicked and made emotional decisions. Market volatility during global conflicts is temporary. The investors who stayed the course during this period, who didn't panic, sell, and who held their SIVs, came out in a much stronger position than those who reacted emotionally. The lesson here is not to predict wars. It's to build a portfolio resilient enough that no single global event can derail your long-term wealth plan. Diversification, emergency fund, and goal-based investing are your protection against the unpredictable. Why nobody reviews their financial year? So, we just walked through 4 major events that shaped FY 2025 to 26. And here's what's interesting. All 4 of these were public knowledge. They were in the news. The RBI announced the rate cuts. The budget was covered everywhere and inflation data is published every month. But most people still miss the opportunity. Why? Because they never sat down to review, and the result, every new financial year begins with the same gaps, the same underperforming investments and the same mixed bag deductions, the same vague sense that money should be doing more, but not knowing exactly why it isn't. What a financial year review actually means. A financial year review is not complicated. It is not something only wealthy people or financial experts do. It is simply 4 questions asked honestly. Question 1. How did my investments perform? Not just the return, but did they perform the way you expected? Are you still in the right fund or your goals and risk appetite? Has your asset allocation drifted? Question 2. Did I optimize my taxes? Did you fully use Section 80C? Did you claim all eligible deductions? Did you miss any opportunity that you can't recover now but can plan for next year? Question 3. How close am I to my financial goals? The home you want to buy? The retirement corpus you are building? The child's education fund? Are you on track or have you silently fallen behind? Question 4. Where did the money actually go? This one is uncomfortable for most people because the answer is really what they expect. Subscriptions, impulse purchases, and lifestyle inflation. The expense audit usually reveals the leak. 4 questions, 1 honest conversation with yourself, all with an advisor. That's all a financial year review is. The cost of skipping this review. Let me be direct about what happened when you don't review. Small gaps today becomes big setback tomorrow. A rupees 5,000 SIP you forgot to increase for 3 years, a tax deduction you missed claiming for 4 years, an underperforming fund you stayed in out of habit. None of these feel significant in the moment, but compounded over time, the cost is enormous. Poor asset allocation silently kills wealth. Missed tax opportunity are money you simply gave away, money that could have been working for you. And the hardest part, most of this is completely avoidable with one annual review. What to do differently in financial year 2026 to 27? Here are the 3 things you can do right now before the year gets busy and the moment passes. Action 1. Review before you restart. Before you make any new investments in the new year, review what you already have. Are your existing SIPs aligned with your current goals? Have your risk appetite or life circumstances changed? Action 2. Automate your tax planning. From day 1, don't wait until February to scramble for tax-saving investments. Start your ATC planning in April itself. Spread it throughout the year, make it automatic. Action 3. Give every rupee a job. That extra money from your tax relief, give it a job immediately. SIP, emergency fund, loan repayment. Don't let it sit in your account waiting to be spent. Review, reassign, restart smarter. That's the only mantra you need for financial year 2026 to 27. Here's the truth. Knowing all of this is step 1. But building a plan around it, a plan that accounts for your income, your goal, your risk appetite, and your life stage, that's step 2. And that's exactly what Fincart does. We just don't give you information, we sit with you, review your financial year, identify the gaps, and build a personalized roadmap for your year ahead. Because the difference between people who build wealth and people who don't is rarely knowledge. Learn from us and start financial year 2026 smarter. And if you want to go deeper, in our next video, we are going to cover exactly how to plan and manage your wealth in financial year 2026 to 27. So make sure you subscribe to Fincart and hit the bell icon because that one is coming very soon.